Welcome to our explainer video on how you, as a beginner, can start investing like Warren Buffett. Investing can seem intimidating, but with the right approach, you can build a solid portfolio. Today, we will break down the steps you need to take to identify strong companies and invest wisely. First, it's essential to understand the philosophy of Warren Buffett, one of the most successful investors of all time. He believes in investing in companies that have strong fundamentals, a durable competitive advantage, and are available at a fair price. These principles will guide you in selecting companies for your portfolio. To begin, you'll want to focus on a few key criteria when evaluating potential investments. The first criterion is the company's financial health. Look for companies with solid earnings, consistent revenue growth, and a manageable level of debt. You can find this information in the company's financial statements, which are typically available on their website in the Investor Relations section. Next, consider the company's competitive advantage. This could be a unique product, brand loyalty, or a significant market share. Companies with a strong competitive edge are more likely to maintain profitability over time. A great example is Coca-Cola. Its brand recognition and loyal customer base give it an advantage over competitors. After assessing financial health and competitive advantage, the next step is to evaluate management. Strong leaders with a track record of making sound decisions and creating shareholder value can significantly impact a company's success. Look for companies whose executives have a history of integrity and transparency. Once you have identified several companies that meet these criteria, it's time to dig deeper into their valuation. One popular metric used by investors is the price-to-earnings ratio, or PE ratio. This ratio compares a company's current share price to its earnings per share. A lower PE ratio may indicate that a stock is undervalued, while a higher PE ratio might suggest it's overvalued. However, it's crucial to compare the PE ratio of a company with its industry peers for a meaningful analysis. Another valuation metric to consider is the price-to-book ratio, or PB ratio. This ratio compares the market value of a company's stock to its book value and can provide insight into whether a stock is trading at a fair price. Buffett often looks for companies with a PB ratio under 1. This means a company's price is less than its assets minus liabilities or net worth. This indicates that the stock is trading for less than the company's actual worth. Now, he also looks at a ratio called return on equity, which should typically be more than 25%. Another important ratio he considers is ROCE, or return on capital employed, which should be significantly more than the cost of capital. Typically, 30% plus is great. If you don't understand these ratios, just Google them and study them. They aren't very difficult to get a hang of. Now that we have a handle on how to evaluate individual companies, it's essential to build a diverse yet concentrated portfolio. Not too many companies and not too few. Typically 10 to 15 companies across industries. Diversification is the practice of spreading your investments across various sectors and companies to reduce risk, but not too many that you can't monitor your investments. For a beginner, a portfolio of 10 to 15 companies is a great starting point. You can choose companies from different industries such as technology, healthcare, consumer goods, and finance. Diversification ensures that your portfolio isn't overly reliant on any one company or sector. As you build your portfolio, keep in mind that investing is a long-term commitment. Buffett famously said, "Our favorite holding period is forever." This means that we should be prepared to hold on to our investments for many years, allowing them to grow and compound. It's important to resist the temptation to sell during market fluctuations. The stock market can be volatile, but remember, it's essential to stay focused on the long-term potential of the businesses you have invested in. A great way to manage your investments is to create an investment plan. This plan should outline your investment goals, the amount of capital you're willing to invest, and your risk tolerance. Understanding your risk tolerance is crucial in determining the types of stocks you should include in your portfolio. Higher risk stocks may offer higher potential returns, but can also lead to more significant losses. Conversely, lower risk stocks may provide stability, but with lower growth potential. After creating your investment plan, it's time to start investing. You can open a brokerage account online, which will give you access to the stock market. Many brokerages today offer commission-free trading, making it easier and more affordable for beginners to start investing. When you are ready to invest, consider dollar cost averaging. This strategy involves investing a fixed amount of money regularly, regardless of the stock's price. By doing this, you can reduce the impact of market volatility on your investments and potentially lower the average cost of your shares over time. Remember, it's perfectly fine to start small. You don't need a lot of money to begin investing. Many companies offer fractional shares, allowing you to invest in high-priced stocks without needing to buy a full share. As you gain experience and your portfolio grows, you can gradually increase your investments. One essential aspect of investing is to stay informed. Keep up with the news in the financial markets, read books and articles about investing, and learn from successful investors. This knowledge will help you make better decisions and adjust your strategy when necessary. Additionally, it can be beneficial to follow the quarterly earnings reports of the companies you've invested in. These reports provide insight into the company's ongoing performance and can offer clues about its future outlook. As you continue your investing journey, remember that mistakes are part of the learning process. Even seasoned investors make poor choices from time to time. The key is to learn from those mistakes and apply that knowledge to your future decisions. In conclusion, starting your investment journey like Warren Buffett doesn't have to be overwhelming. By focusing on solid companies with strong fundamentals, diversifying your portfolio, and committing to long-term growth, you can build wealth over time. More than anything, investing is owning a piece of a company, so you should buy with a mindset of holding your investments for life and sell only when you need the money or something drastic has happened to make the company's fundamentals bad. Remember to stay informed, create an investment plan, and be patient. The path to financial success is a marathon, not a sprint. Embrace the process, and soon you'll be on your way to investing like one of the greatest investors in history.